In 2008, the United States faced the worst financial crisis since the Great Depression. It resulted in a global emergency. The worldwide market was in a state of shock as the United States housing prices rapidly dropped due to a series of unfortunate events. In the early 2000s, the housing market was at an all-time high. Prices were on a continual rise. The housing market seemed to be a safe investment, attracting a market of consumers who wanted in on the high returns. Low interest rates created an incentive for banks and investors to hunt for riskier assets that offered higher returns. Banks began to loan out subprime mortgages to people with bad credit history. In 2008, the housing market took a turn for the worst. The economy froze. Banks were not willing to loan. People couldn't pay back the bank, and therefore banks had more money going out than they had coming in. This caused multiple big banks and corporations to go bankrupt. One of these banks was Lehman Brothers. The collapse of Lehman Brothers in September of 2008 almost brought down the world's financial system. Due to a surplus of risky, unregulated loans, the bank went belly up and the government was unwilling to intervene. As a result, the world's financial system was hanging on by a thread. Other companies like Lehman Brothers went bankrupt as a result of the financial crisis.
So my name is Dave Carlson, and I was working for a firm called Marshall Capital Investments, or Marshall Capital Management, which is an institutional money manager. So we managed mutual funds, and then we managed also large institutional accounts. So at the time of 2008, we had a number of the Fortune 500 companies were actually our clients. Lots of pension funds and mutual funds, insurance companies. Well, it's a pretty tumultuous time. At that time, we were probably about $110 billion in assets that we were managing. And so during that time, the stock market dropped almost 50%. So, out of 110 billion we were managing, without losing any accounts, we were down to like $55 billion in assets. So it was pretty substantial decrease in the assets that we were getting paid to manage on. And then also, because of the panic that was in the marketplace, a lot of clients, a lot of individual investors were pulling money out of the market, so we were flooded with a lot of redemption orders from the mutual funds that we were managing, so we had to continue to sell stock. So we were selling stock in a market that was going down. All the gains that we had recognized over the years, we were quickly losing those gains and they were turning into losses. Well, like I said, put a lot of turmoil. A lot of the brokerage firms that kind of got acquired or taken over or even went bankrupt, were some of our largest brokerage firms that we use to trade stocks with. So it was really, a time of a lot of panic. Like I say, we saw the market going down significantly. The traders that I was working with, a lot of days they'd come in and they would just say, the market is going to zero because we saw such huge down days in the market, for like a couple weeks period of time that we thought the whole financial system was going to collapse. So it was a pretty frightening time. It was a really frightening time.
The economy was in pieces, and we were in a Great Recession. According to useconomy.com, housing prices fell 31.8% more in 2008 than they did during the Great Depression. 2 years after the recession had ended, unemployment was still above 9%. Unfortunately, the crisis's effect was global due to the fact that global investors had bought mortgage-backed securities. Many other countries fell into a recession. The world's economy suffered due to the U.S.'s housing market crash.